Hello everyone, this is Kathy Lien with BK Forex, and I'd like to welcome all of you to my Eurodollar Tips and Trading Strategies webinar. I'm going to close the chat box because it's just kind of floating in the screen, but if you've got questions, feel free to fire away, and I'll reopen the chat box periodically to see if I can get to your questions. I'm assuming that this will be recorded by FX Street. And once again, like I said, I'll be opening up the chat box periodically just to make sure there aren't any issues or anything like that. But right now, we're going to shut that down. So today, we're going to discuss Eurodollar tips and trading strategies. Here's a disclaimer that says trading Forex carries a high level of risk and may not be suitable for all investors. Are watching this video on demand, I highly encourage you to pause the screen, read through the disclaimer thoroughly before moving forward. So we're going to be talking about all things euro today, and it's obviously quite interesting because the euro is the most actively traded instrument in the financial markets, and I do believe that it is very exciting for everyone to trade and pretty much sufficient for the most part. And you'll see that because we've got both range trading as well as trending opportunities. So plenty to go around when it comes to trading the euro dollar. And, the reason why euro dollar is the most actively traded currency is because the most actively traded instruments for the most part are the US dollar and the euro. The US dollar encompasses about 80% of all foreign exchange transactions, and the euro dollar, because when it comes to trade activity and miscellaneous things, when it comes to trade activity and miscellaneous things, most of it is against the US dollar. And of course, euro is very much actively traded as well. So when it comes to trading, we believe there are three ingredients for a perfect trade. And when it comes to trading, ideally we would like to look for as many quote unquote stars in our favor as possible. And that is why whenever we're trading, we're looking for fundamentals, technicals, and sentiment to be on our side. So we start off with fundamentals. The fundamental backdrop for the eurodollar is what's driving the volatility as well as the opportunity in currencies. And the reason why we talk about that is because, on a day-to-day basis, it is the troubles in Europe and the outlook for the dollar that is really a big focus. So when it comes to the euro, just some general background information. The most important thing to know about the euro is that it's a currency without a country. There are 19 members in the Eurozone, and if you've been watching the headlines or if you've been around during the European sovereign debt crisis, you will know that it only takes one country to bring down the euro. In this case, right now, we're dealing with Greece and the possibility of a Grexit, which means the Greece leaving the Eurozone is, really weighing heavily on the currency. And as much as the ECB or German policymakers may be trying to downplay that significance and saying that there would not be too much instability if Greece left the Eurozone, I guarantee you the announcement of a Grexit will trigger quite a bit of volatility, not only in the euro dollar, but also in European bond yields. So, the dialogue does seem like it's moving that way with Germany's Schäuble as well as members of the ECB suggesting that they would be okay with a Grexit, or they will allow a Grexit to happen if we basically had a scenario where Greece would not commit to any reforms. Now, of course, the Greeks themselves are in a bit of a tizzy because because we're running out of time. And we're running out of time basically during a period, a very dangerous period in the markets. When it comes to the Greek crisis, I think everyone has to realize that Greece is playing a very dangerous game of chess. I mean, they basically missed their latest IMF payment, decided to bundle that payment to one lump sum payment at the end of the month. So they're basically taking a step back and saying to their creditors that we're not paying you until you give us another bailout, until you extend our bailout funds, or approve another set of bailout funds. And if you don't, we're going to default on our loans, which is going to spell crisis for the rest of the region. Now, this is creating a moral hazard, or their creditors are worried about creating a moral hazard and creating a situation where they just kind of bend over backwards to these threats that Greece is making, and just end up extending their bailout payments. So they're trying to push it as much as possible as well. So at the end of the day, this is probably going to be an 11th hour deal, because I think that the consequences all around are too severe for the Eurozone to allow Greece to leave the region, because it's not just about Greece. If it was just about Greece, then you could cut off the gangrene limb and be done with it. But what it's about is contagion, and what it is about is what happens next. Does that mean that any country can be kicked out of the Eurozone, including Spain and Italy? Many countries in the region have very high debt levels, so it could be a slippery slope. But of course, creditors are fully aware of this, and that is why one country in the Eurozone can really bring the region down. Germany is the largest and most important country in the Eurozone. You're right, Boyke. It's probably just going to be another payment to another installment to pay the creditors. So in some ways, the EU and IMF are giving the money, giving Greece the money in order to pay back themselves. So it's a dangerous predicament, and it's not one that the creditors want to follow through with. But I think the consequences are quite severe. So I'm banking on no Brexit and a deal at the end of the month. But even if we have between now and then, we could have additional euro-dollar weakness with maybe a little bit of relief rally after a deal is announced. So once again, Germany is the largest and most important country in the Eurozone. So when it comes to Eurozone economic data, we primarily center on data from Germany, and that's really what we focus on. When it comes to trading the euro dollar, there are 3 primary sessions, and there are different opportunities around those sessions. The best times to trade the euro is around the London Open, or when European economic releases come out, which is sometime between 2 and 4 a.m. New York time, and also the U.S. dollar component, which is when the U.S. economic releases come out at around 8:30 a.m. to 10 a.m. New York time. That's when you tend to see the most volatility in the euro dollar. You also see a lot of volatility at the European close, which is about an hour from now, noontime in the U.S. So tips for trading the euro. Euro is the most actively traded currency in the world. It tends to trend much more than it ranges. And as it's highly correlated with risk assets, unless it's a focus in Eurozone credit. And right now, these days, it is very much a focus on Eurozone credit. So talking about the euro and the Eurozone risk, on a fundamental basis, we think the euro is headed lower from a Eurozone perspective. The reason is because, even if Greece gets an extension to its bailout payments, the problems are not going away anytime soon. We're going to be talking about Brexit till the end of the year, and that's going to provide ongoing pressure on the euro dollar. At the same time, the ECB has said that they're not going to be front-loading QE, which means that they're going to be extending QE for a longer period of time. So that also poses a risk for the euro dollar. Data from the Eurozone hasn't been all that terrible. We're starting to see the benefits of quantitative easing by the European Central Bank. We're also starting to see the benefits of a weaker euro. So collectively, that is all providing support for the Eurozone economy, giving us some positive Eurozone economic reports. And so while, we always say that the path to a stronger currency is through a weaker one, and we're getting that for the euro. But I think there's, because the desynchronization of monetary policy will be the primary driver of currency movements for the rest of the year. The fact that we're going to get some action by the Federal Reserve and some lack of action by the ECB very much means that that there could be some more pressure on the euro dollar on a fundamental basis, and a lot of that pressure will probably come from the U.S. dollar itself. And the reason why we say that is because monetary policy is a big driver, and we are moving towards the possibility of liftoff when it comes to the Federal Reserve. I think that when the Federal Reserve meets next week, they are going to lay the groundwork for raising interest rates in September. I do not think they're ready to raise interest rates quite yet, because overall, even though we've had an increase in average hourly earnings or wages, overall wage growth still remains slow. But if you take stock of how the U.S. economy is doing, manufacturing sector is so-so, service sector is so-so, but job growth is strong. Retail sales are expected to recover strongly. Inflationary pressures are on the rise, and average hourly earnings are increasing. So we're certainly moving in the right direction. And I think that the Federal Reserve come June, this month or next week, they are going to be the language in the FOMC statements, the language or the tone of Janet Yellen's press conference is very much going to signal that we're moving closer to raising interest rates. And so I think there's scope for further dollar gains from now into September. So that's going to create an upward bias in the dollar, pressure on other non-dollar currency pairs across the board. So that's a look at policy. U.S. economy, how's it doing? We already talked about that, and we already talked about how, in general, if you take a look at how the U.S. economy is doing, it's we had a first quarter weakness that was created by kind of inclement weather and just a little bit of a loss of momentum, but we're recovering from that. And, as we're recovering from that, I think that, we'll probably see a bit more strength in the U.S. economy in the second half of the year. So, definitely getting quite excited about that because, that is only going to lend additional support. That's going to lend additional support for the Federal Reserve's plans to raise interest rates. Now, of course, when the Federal Reserve actually moves forward with raising interest rates in September, we think that there's a very, very strong possibility that they're going to downplay that move and say, okay, we've raised interest rates, but even though we've already raised interest rates, we're not going to be following through with back-to-back. We're not going to be following through with back-to-back tightening. We're going to assess and see how data is doing, and then we're going to raise interest rates again after that. So she's going to downplay the move. So I think the dollar may actually weaken after initially spiking higher when the Fed raises interest rates. So the real opportunities from now until September. The real opportunity is to buy U.S. dollars now and look to sell it after the FOMC rate decision in September. So that's basically what we are we're looking to bank on. So risk ahead for the U.S. dollar. The main risk for the U.S. dollar is actually U.S. dollar strength. The dollar has risen 6% since the beginning of the year against most of the major currencies. And a strong dollar is bad for U.S. corporates. It reduces inflationary pressures. So the Fed knows that the dollar is only going to get stronger from here. So given that they know that the dollar is only going to get stronger from here, the real main opportunity is going to be just to get stronger from here. The real main opportunity is to kind of mitigate that move by downplaying the tightening or liftoff when it happens. So that's why we're going to be very cautious dollars come September or so. But from now until then, we're going to be quite bullish. So that's the backdrop. How are entries and exits determined? Well, they're determined by trading strategies. And, one of our favorite trading strategies are the double Bollinger Bands. You may be familiar with Bollinger Bands. Typically, when you put Bollinger Bands in your charts, you're looking at the 20 period, 2 standard deviation Bollinger Bands. My style of trading has always been to add 2 sets of Bollinger Bands, 20 period, 2 standard deviation Bollinger Band, and 20 period, 1 standard deviation Bollinger Band. And this creates opportunity for us and I think some interesting trade opportunities that you'll see when we lay our Bollinger Bands on the charts. So right now I've got a chart. My right-hand side screen is simply my quote screen, just kind of monitoring rates. So what I'm going to do is I'm going to lay on 2 sets of Bollinger Bands. The first set is a 20 period, 2 standard deviation. And the second set is, and I'm going to remove the basis so we don't have too many lines. And the second set, we're going to add on another set. The second set that we're going to add on is the 20 period, 1 standard deviation Bollinger Band. So how can we use this information to help us trade? Well, what you would do is, first and foremost, there's a couple things that I want to share with you. When the currency pair in the euro dollar in this case is trading the 1-2 band the upside, we say it's in the buy zone. When it's trading the 1-2 band this downside, we say that it's in your sell zone. So there's many different ways to trade the double Bollinger Bands, and the one that we're going to look at specifically today is to use the double Bollinger Bands to pick tops and bottoms. First of all, what I want you to notice is that when the currency pair is in a strong trend, it will remain within the 1-2 band the downside or 1-2 band the upside. And you see that in this period here, this period, and this period. When it is in the range trading zone and it comes out of either the sell zone or the buy zone, oftentimes it will have to touch the Bollinger Band on the other side. So the way you can use the Bollinger Bands to pick tops and bottoms is that rather than arbitrarily picking a top and bottom, what I would suggest to you is I would, if you take a look here, you see the currency pair trading in the sell zone in the bottom of this chart. If it closes above the first standard deviation Bollinger Band, that's when you would buy, targeting the first exiting half of the position when it touches the Bollinger Band the other side, and then maybe trailing your stop on the remainder position, hoping to get more. You see that also in this part of the chart. Let me know if you can see my mouse moving around. Can you see my mouse moving around? Sure, Med, you want to use the symbol. Okay, great. So here, I'm going to close this chat again. Here, in this case, the currency pair closes below the first standard deviation Bollinger Band. You want to target the Bollinger Band on the other side. This is obviously a stop-out trade. You'll have winners and losers, but as you can see in the chart here, you have a lot more winners than losers. Here's another example. We're in the sell zone. We close above the first standard deviation Bollinger Band. We target the Bollinger Band on the other side. Here, we're in the buy zone. We fall below the first standard deviation Bollinger Band. Then we target the Bollinger Band on the other side. Same story over here. Closed above the Bollinger Band. Target the Bollinger Band on the other side. Your stop will be at the swing low or a couple pips, maybe at 20, 30 pips below the first standard deviation Bollinger Band. Here, same story. You close above the first standard deviation Bollinger Band. It takes some time, but eventually we target the Bollinger Band on the other side. And we get a very nice move over here and capturing the downtrend. So that's one way to use the double Bollinger Bands to help us basically pick major tops and bottoms, and this would be on a daily chart. So one question I have here is, can this only be used in a daily chart? I would use this technique primarily on the daily charts. If you are looking to use this technique on a different time frame, I would use different moving averages, different sets of Bollinger Bands, because with these Bollinger Bands, they're more longer term, so we can use, a smaller standard deviation. But if we want to trade on an intraday basis, we look at the 15-minute charts, and instead of using the 20 period 1 standard deviation Bollinger Band, we want to remove the 1 standard deviation Bollinger Band, and we want to add in the 20 period 3 standard deviation Bollinger Band. So that's what we use when we are trading shorter term charts. And the rules are similar. But what you want to do in this case is you want to look for the currency pair to close at or above the third standard deviation Bollinger Band. Then you want to see it drop below the first standard deviation Bollinger Band, and all you're looking for is a 10 pip move. So this is one of those 10 pip trades. So let's work backwards here. We don't have any trades in this chart here except for over here. So basically, we have this trade over here. And because the euro dollar closes at the third standard deviation Bollinger Band, you don't take a trade until it closes back above the first standard deviation Bollinger Band. And it does so at 112.91. So your target is 10 pips at 113.01, and this high here is 10, so you easily meet your 10 pip target. The next trade we have is over here. Over here, you see the currency pair close at or above the third standard deviation Bollinger Band. We wait about 15, 30, 45 minutes. It closes below the first standard deviation Bollinger Band. We sell here at 113.20, going for 113.10. The lowest this move is 06. So once again, you've had your 10 pip profit target. No trades over here. So this is why we get filtered out of weak trades. These Bollinger Bands help us filter out weak trades. Here's another setup. We're closing at the third standard deviation Bollinger Band. So 3 times in a row, you're not selling here, you're not selling here, you're not selling here. You're waiting for the euro dollar to close below the first standard deviation Bollinger Band, which happens right here. The low, the close is 111.32. Our target is 22. The low of this move is 12, so we easily hit our profit target as well. You don't want to be trading here, even though it would have worked because this is the Sunday open. Here's another example. Here we see the euro dollar close at or below, in this case, the third standard deviation Bollinger Band. We wait, and this is when we enter a trade somewhere around here. Let's just say over here at 110.67. We go for a 10 pip move. It moves much more than 10 pips. You can also use a 1-2 entry and exit in this case if you want to ride more of the move, because as you see in this case, we got much more than 10 pips. Let's look at another example. This is a close above the first standard deviation Bollinger Band. This is a stop out, which will happen. Here's another example. We close at third standard deviation Bollinger Band. This is the trade. We go long at 112.04. High is 22, so we obviously would have hit our profit target as well. We'll just look at one more example, which is right over here. We close at or above the third standard deviation Bollinger Band, and we drop below it, so we go short at 113.10. Does move a little bit against us before finally hitting our profit target. And if you put your stop at the swing high, you would have not been stopped out. So that's how you can use the Bollinger Bands to help you capture a short-term trade in the euro dollar. Now, I have a question here about whether this can be used for all of the major currency pairs, this 15-minute technique. It can be used on the majors, but we focus on the euro dollar, pound dollar, because dollar yen's been kind of range bound. Dollar CAD also doesn't see a huge move. Aussie could work too, as well as Kiwi, but it works best on the euro dollar as well as the pound dollar. So I want to share with you one more trading technique. And this trading technique uses two moving averages, the 50-period simple moving average and the 100-period simple moving average with the MACD on the daily chart. So let's remove our indicators here. Go back to the daily chart. We're going to add in our 50-period moving average. And then we're going to add in our 100-period moving average. And we're going to add the MACD. Okay, so now we've formed our chart. And let's find our trade. So the way this works is that this is a trends-based trading strategy. So what you want to do is you want to wait for the currency pair to close above both the 50 and the 100-period moving average. But just because it does not, or close below, but just because it does not mean you take the trade. Instead, what you want to do is you want to check the bottom, make sure MACD is turned in that direction. So if it's a long trade, you want to see MACD turn positive within the past 5 bars. If it's a short trade, you want to see MACD turn negative within the past 5 bars. So in this case, right over here, this is not a trade because even though we've closed above both moving averages, MACD's been positive for at least 8, 9, or even 10 bars. What is a trade is, this is not really a trade, is right here. We closed, is the current trade. We closed above the moving averages right over here. MACD just turned positive. So you would have gone long here at 111.15 with the stop, below the moving average, and you can go for a 50 to 100 pip profit target. So if we went long at 111.51, right now it's trading at 112.60s, we would have definitely hit our profit target. Or you can use the better way for risk rewards to use 1 times risk. So if we go long at 111.51 and we put our stop at somewhere below the blue line, which is let's just say 110. Let's say our stop is 75 pips. We would have basically exited position at 112.25, or at least half of the position. Let's look for another example. Now, this is one of those rare trading strategies. Obviously, it doesn't happen very often, but when it does, it's quite powerful. Here's another example here. Also, you see the currency pair closed below the both moving averages, and here we see that MACD's just turned negative, so we go short with a stop, maybe about 20, 30 pips above the moving average, the furthest moving average. And this is the beginning of a very prolonged downtrend in the euro dollar that goes from 137 all the way down to 105. So, I'm certain you would have captured at least 100, if not more, pips on this move. Let's look at another example here. Now, we weren't trading below both moving averages, but even if we were, the MACD didn't turn positive there, so there's no trade. This is a valid trade right over here. Let me try to get my crosshair going here. This is a valid trade right over here. We go long, and you can see the beginning of a multi-100 pip move in the euro dollar. This is also a valid trade. In this case, we would have short at 135.52. The low of this move is 134.80. So I think you would have gotten about 75 pips in this move, maybe even more than that, depending upon how you traded. This one is not a trade because MACD's been negative for quite some time. And this one over here, although this one over here, the trade is right over here. And once again, another really good trade. Our stop would have been somewhere down here. So that's how you would use the moving averages to help us join a trends-based move in the euro dollar. So we looked at using the Bollinger Bands to join a move to pick a top and bottom in daily charts, to pick a top and bottom in 15-minute charts. We use the MACD and the moving averages to help us basically join a trend-based move. We're trading every day at BK Forex, so I encourage you to check out our website. We've basically have a lot that we're doing, and So we have a lot that we're doing, and we've been doing quite well. So I invite you to just check out our website, sample our service, and we do have strategies for trading many different currency pairs. But what I want to leave you with is that in FX, horizontal lines are much more important than vertical lines. That's why in terms of support levels. And another tip is that round numbers are difficult to break first time around, but when they're broken, it can be quite important and big. Right now we're in a long dollar CAD trade, we're on the break of the 100, so it's looking pretty good. It's an example of a round number trade we take it for our BK Forex members. Sentiment is always key. You want it on your side, but of course if it's extreme, any reverse news could trigger a massive reversal. So if there's one thing to take away from today's presentation, we hope that it's that you want fundamentals, technicals, and sentiment on your side for every trade. And that's what we try to do at BK Forex with our big trades and day trades. We try to have all three of these things on our side with every trade. Thank you so much. Now I'd like to open up the floor to any questions that you may have. I've left 15 minutes for Q&A, so feel free to fire away with the questions. What's the best value for moving averages on a 15-minute chart? I prefer the 20-period exponential moving average. In terms of sentiment, basically what you want is you want sentiment on your side. So sentiment is a little bit more vague and hard to describe, but generally speaking, you want an environment where the market, is overall bullish dollars or bearish euros, and you can look at that a little bit using COT positioning. I do use fib retracements just to help me identify key levels of support and resistance for my trades, and but not to implement, but not to execute trading strategies. Once the U.S. starts to raise Fed funds, what will be the effect on euro dollar? So here's the thing. I think it's the lead up to tightening that would be bearish for the euro dollar. But, just like ECB QE, ECB QE was announced, let's get rid of all these indicators. ECB QE was announced in March. And look what happened. It dropped for a couple of days, then we're trading much higher, and then it bottomed out. So while it's supposed to be very bearish euros, it didn't really turn out to be. So, it could very much be the same situation. What is on the right of the screen? The right of the screen is my quote board, my personal quote board. This is eSignal. It's not MT4, so I don't think that you can just add it. I do look at candle formations, but not very heavily. And then do I use 4 hours for Bollinger Bands? No, I do not. Any other questions? Or charts that you may want to look at? All right, I'm gearing up to put another trade idea in euros for our BK subs. So if you don't really have a question, I'm going to thank you for joining me today. On MACD strategy, how much stop loss do you use? We put the stop below the moving averages by, a comfortable amount. Short-term Bollinger Band settings, can you please confirm? It's the 20-period 2 standard deviation, 20-period 3 standard deviation. I know there are a couple of BK members here, so we're going to be firing out our euro-dollar trade in just a minute as soon as I get a chance to put the levels together. All right, any other questions? Could you maybe talk about what's happening euro dollar right now, how you would trade it? Like I said, we're going to be selling euros a little higher. And if you want to know how to trade it, you know what levels we're looking at, become a BK member. Triple moving average, no, I do not use the triple moving average. 10 pip targets, we trade 10 pips a day, 10 times a day in our 24-hour chat room, Boyke. It's what Boris does with our subs all day long. So, there's definitely some merit to it. Any other questions or charts that you may want to look at? Would you still use the same 23, 22 Bollinger Bands pairs that tend to range rather than trend? Yes. Are you bullish on Kiwi dollar? No, I'm bearish on Kiwi dollar because I think there's a pretty good chance of a rate cut by the RBNZ this week. Pound dollar, there's a head and shoulders pattern, pound dollar. Take a look at it yourself. Today's presentation is focused on the euro dollar. And maybe we'll come back and we'll do £10 dollar next month. You have to be a member of bkforex.com. Arnold, I'm not too sure what your question is. But, you know, the 50-100 SMA is used for the daily chart. Okay, so I gotta leave this trade out for BK subs. So no, I do not follow Elliott Wave or anything like that. So I'm gonna thank you all for joining me today, and I hope you enjoyed the presentation.